Hi everyone, you're all very welcome to another Alpha Capital video. Today we are looking at obviously the Fed FOMC Fed Day over in the US today, obviously with the latest interest rate decision coming from the Federal Open Market Committee. So today obviously all eyes is going to be on the broader committee come 7 o'clock tonight UK time for updated bias on where they foresee the economy to be. Looking at all of the important information like core PCE, broader growth, inflation, employment, and everything else that goes along with it to make up all of the key economical footprints of the broader US economy. Now, obviously today as well, Fed Chair Powell will be on the stage at 7:30 UK time tonight as well, where there'll be a press conference Q&A. So you'll have two kind of backdrops of volatility. You'll have the initial movement off of that 7 o'clock data point or data print, obviously with the FOMC statement of economic projections, which will be coming out, and of course the Q&A itself at 7:30 when he starts to give his own comments, his own opinions on where the markets are currently at in the backdrop of that. So today, over the last couple of days or so, into the tail end of last week, we have seen some fairly strong dollar movements in the markets. That did very, very quickly abate last week. And of course, we actually have seen risk assets do prominently well into obviously the close of this week, and more poignantly even yesterday as well. We saw massive volatility in gold markets yesterday. The FX markets as well, euro dollar had seen some fairly significant moves to the upside, and even the indices, which has been fairly choppy, very, very tumultuous over the last weeks, has also proved to have a little bit of upside as well. So there's a little bit of a headwind today into obviously the FOMC this evening. But I suppose the goal here today is just to look at the different scenarios of what's presented tonight, looking at kind of the key important piece of data, understanding that rationally to obviously help with traders' decision-making process. So if you're scalping or you're day trading, if you're trading fundamentals, this call hopefully will be useful to you more broadly. So without further ado, I suppose first things first is taking a look at the economic calendar. So as we said tonight, we have got the Federal Open Market Committee at 7 o'clock tonight. And before that, of course, at 2:45, 3 o'clock, we have a number of PMIs and ISM data coming out in the US as well. Now, I suppose overall, any other day you would expect fairly decent volatility off the back of that data point. However, today with the Fed, obviously with markets, obviously in a lot of circumstances, I think a lot of participants are really holding off till 7 o'clock tonight, not to be, I suppose, carrying any kind of sort of significant drawdown or even minor drawdown into what could be a very, very volatile event. And you only have to look at any of the FOMC meetings over the last kind of 6-9 months to really ascertain and understand how volatile these events can be. And I suppose understanding that in times of increased volatility, you are going to get wider slippages in markets off of those initial spikes in data. So it's important to be patient, to be rationalized in what you're doing, making sure you have that clear process, but also at the same time, when there's clarity in the market, obviously navigating around that kind of spikes in volatility as well to protect your account, mitigate the risk associated to your account privately or whether it's externally based, and obviously making sure that you take advantage as best you can of some of those opportunities that present themselves. So I suppose without further ado, looking at the Fed obviously tonight, the expectation is by a wide number of commentators, analysts, is that we see another 25 basis points increase by the Fed tonight. So last time around, they were expecting 25, they got that 50. There was a little bit of a headwind. We saw that increased volatility, but I really think tonight you're going to be looking at 25. Now, that's not to say 50 or no hike are off the table, but market consensus is pricing in the overwhelming majority in terms of probabilities that there'll be 25 basis points tonight. I think that's pretty much priced into current market conditions. You also have to look at, well, then if the two other scenarios present themselves in terms of maybe a 50 basis point increase, I think you're probably going to see a little bit of risk aversion. You're going to see risk aversion. You're going to see risk assets getting hit. You're probably going to see selling in the likes of some of your FX crosses against the dollar. You're probably going to see some fairly decent opportunities in the indices as well. Similarly, again, if they turn around tonight and they opted not to increase rates at all and hold steady at that 5% level, given now that 5% is currently the terminal rate of 5% of the interest rate is now for the first time in nearly 2 years above that inflation level of what came out just 2 weeks ago in terms of 4.97% on the inflation, then you'll start to see obviously that kind of pivot. And if you start to see that pivot, then you're probably going to see that little bit of risk aggression we saw through the morning actually become a little bit more of a follow through, where you'll see risk assets actually probably do quite well. But again, that's 7:30. That's initial movement at 7:05, where you get that statement of probabilities, statement of projection, should I say, and of course the actual confirmation on the interest rates is really going to be something to mitigate around, right? Yeah, if you can get your EAs and you can get placed, absolutely, yeah, great, absolutely, that's brilliant. But for a lot of assets, and of course, with the market conditions, it may be very, very difficult to actually get execution and get filled in some of those positions. So you just have to be wary of that. Don't be chasing positions that necessarily have, as you kind of say, have left the building somewhat, so to speak. So as I said, 7 o'clock is obviously going to be very, very important in that regard. Now, in addition to that, we obviously have shared some very, very useful content today in our Discord community, just about the different scenarios, making people aware of this increased volatility, just so they are kind of aware of the potential issues that could be in front of them should they be carrying maybe extensive risk or heavy trade into the obviously 7 o'clock statement. Now, of course, we've got the different scenarios. Now, this is of course courtesy of ING Analytics. So, of course, you've got the different scenarios. You've got the dovish, you've got the very dovish, you've got the base case scenario, which is kind of what we're expecting. Inflation is unacceptably high, which has kind of been the narrative, particularly if you look at commentary over the last week or so. More pointedly, sorry, this week, by different institutions. Even listened to some comments from Munchin yesterday. So there's obviously still very much upside risks in the economy. So really, from a fundamental perspective, we should be really looking at the Fed. As I said, probability, this will probably be the last increase if it is an increase of 5.25%. But then obviously looking at that pivot, holding interest rate then through the back end of the year, really to try and keep this interest rate as high as possible until it really breaks down these kind of inflation levels, seeing those inflation levels get back into that under that 4% level, which we'll be looking at there in a second. So this is obviously very, very useful. It has been shared in our Discord as well, with another article accompanying it too. So again, the more information traders have to hand tonight, the better they will be, because of course they'll have more information and more understanding of what's going on. Now, the second document we kind of want to show you today is, of course, going back to the previous statement of economic projections. So this is, of course, the summary of economic projections, which is conjunction with the FOMC meeting, the statements, and so on and so forth. Now, of course, when you're looking at how the FOMC decide of where they put their interest rates, there are kind of four kind of key things that they look at, right? And it's detailed very, very clearly here. They look at GDP, they look at unemployment, and then they look at price stability. So price stability comes in two fronts, PCE, which is personal consumption expenditure inflation, and of course the core PCE, which is obviously the headline inflation as well. So those two things are really going to be prevalent in obviously the next, not just tonight, but over the next 6 months, okay? So the goal here is that the Fed will obviously look to probably do one more rate hike, bring those rates to 5.25%, but allow to have those rates higher for longer through the back end of 2023, through the summer period into the autumn as we approach kind of September, October. And the likelihood is then you might see a little bit of a cut before the end of the year. But if you're looking at current expectations of where they actually see the rates, well, based on the data that came out in March 22nd of the previous FOMC meeting, the Fed expects its funds rate to be around about 5.1%. Okay, now it's currently at 5%. So really, there's not really too much more that they're going to do in terms of increasing the rates, because they know the inflation is coming down fairly steadily. Nearly every month or so, it's coming down by 0.5% here and there, or almost close to that. So they're happy just to leave it be for, let's say, 5-6 months. And by doing so, that inflation levels of 0.3, 0.4 every month comes back to those downside targets of where they're looking at. Now, the PCE inflation, they're looking for inflation really to come down to somewhere between 3-3.5%, right? That's really the goal that they're looking for, okay? And I think that's really, really important as well, because that sets out then where their rates policy is going to be for the rest of the year. Now, if you're looking at GDP, now recently, if you look at the data last week, US GDP was 2.6%. Previous figure, the consensus for April was obviously 2%, but it actually came out much worse than that. It came out at about 1.1%. So it shows that the knock-on effect of having higher rates is very much clearly being seen in terms of the change in the real GDP, because of course the back end of last year, even despite those increases in rates, the GDP was actually holding up very, very well. But of course now, 6 months later, where the effects of those rates are now starting visibly coming into effect into the economy, as a result, the growth is starting to obviously wane and come down. So that obviously brings in the idea of stagflation, negative GDP, consecutively obviously brings in that the recession discussion point. And of course, if you're listening to some of the CEO comments yesterday from like the likes of Lazard, you will see that they're calling the economy, they're saying the economy is in trouble, it's breaking, and that the Fed isn't doing anything to help the situation by having ultra high rates. But unfortunately, the only way to bring down the inflation, to maintain or redeploy that kind of price stability in the markets, is by having those rates higher, because of course there is a negative correlation between obviously inflation and interest rates. When the inflation goes up, the only way to bring that back down is by increasing those rates. And then as the inflation comes back down accordingly over, let's say, a 6 to 12 month period, they'll start to pivot, they'll start to change their policy, and they'll start reducing the interest rates accordingly. So that's how market dynamics works in that regard. Now, the other point that I kind of want to look at is today is also looking at where the FOMC sees the rates over the next number of years. So 2023, with the exception of one, they all see the rate by the end of the year holding above that 5% level. It's only in 2024 when we really start to see rates coming down much sharply. And I suspect the base case scenario next year, we'll see something like this. We'll see rates probably filter back into this 3.754% level until the inflation levels actually come back to those levels of where they're looking for price stability of 2.5% longer term inflation, and obviously keeping the rates at that 2.5% level as well. But it's going to take some time to get those rates back down to that 2.5% level. And most likely, it's, as I said here, with the statement of economic projections, it's not going to really take place until 2025. So of course, let's just see how that plays out. If we start to see a really deterioration in growth, that's probably the only thing that maybe will enable the Fed to move quicker, right? To move quicker by reducing those rates quicker. But in order for them to reduce those rates, they need to have the inflation coming back down. Otherwise, they're back to where they started just obviously 2 years ago. So that's effectively it in terms of the preview. If we look at price action just next into the market, well, we've seen some very aggressive moves yesterday. So of course, the big kind of thing that I've been looking at this week is the dollar, the back and flow, the choppy volatility in the dollar. We did find bottoms in the dollar in that 101 level last week, last Tuesday, last Wednesday. We got a little bit of a rally into the tail end of the week where we saw price action come back up into this 102 level. But again, the dollar has reacted. We've seen a little bit of selling come through yesterday. We've seen a fairly clear follow through the Asia session last night to the downside. And of course, that DXY has remained very much in the back foot. Now, with the DXY weakness in the back foot, euro dollar has very much progressed to the upside. So you've seen gold progress to the upside there. You can see euro dollar progress to the upside, although there's a little bit of profit taking coming in this morning around this 110.50 level. We saw that very, very clear break of this 3-week consolidation in gold. Very, very aggressive. Now, again, you'll see here as well, all eyes is really how we act around this 2005, 2010 level. Does the price action break back under here? I think if we break back under 2010, you're going to see that slide all the way back into this value area where we saw market rallies today. And I think that's just something I wanted to show you as well. Of course, on the upside, where a bias becomes a little bit clearer from the FOMC and we see that kind of risk assets continue to emerge to the upside, we can see that weaker dollar. You're probably going to see gold fly into these session highs from middle of April, 13th, 14th of April, which saw gold come into this 2040, 2045 level. So it's just about being clear with the price action, having a focal point with the clarity, and then being able to make very, very clearly defined decisions off the back of that accordingly. All right. Now, some of the other FX pairs we've seen cable very choppy up and down. And I suppose when you look at cable 4-hour structure, just higher time frame dynamic, order flow is still very much to the upside. So we're getting that continued bullish order flow. We did make session highs or new current trend highs on Friday just above that 125.50 level, just shy of 126. However, we did see that mitigation back into that value area. So that value area back into this 124.50 level, very, very strong reaction from this price action zone. And of course, through the Asia session, with that weaker DXY overnight and through the European session this morning, we've actually seen cable progress back above this 125 level again. So it'll be interesting to see from a value point of view. Value profiles are actually quite useful during days like this to see if there's any sort of reaction down here around 124.50, 124.70, and then being able to ascertain that very, very clearly as well. All right. So moving across then just really into the indices. Again, we've talked about at the very, very beginning. Indices have been very, very choppy the last couple of weeks or so. Very, very up and down, meandering. The broader trend, obviously, in indices is still moving higher and has been since really the beginning of the year. But when you look at broader price action from a focal point, you can see as well that not alone is the S&P moving higher, but so is a lot of its counterparts. So the likes of the NASDAQ, the likes of the Dow Jones, and even its European counterparts as well, the DAX Euro stocks has continued to outperform through the course of the year. And we saw that through Q4 of last year, where DAX Euro stocks collectively went on a very, very significant rally. Excuse me, guys, my camera's just decided to fall off the laptop or computer. And obviously we've seen that accordingly being priced into the market. So really, from a short-term perspective, as day traders as well, you'll see that over the last few weeks we've had that kind of break of April lows on Wednesday of last week. We've seen market dynamic go back up into that 4,200 level before actually selling off yesterday, but we have seen a little bit of a modest recovery from that 4,090 level last night, and market dynamic is still very much poised to the upside as we speak at this minute. So unless we start to see deterioration in sentiment, a breakthrough back underneath probably 4120, 4125 today, you're really looking for that to be the catalyst to revisit some of those monthly lows we saw last week. And of course, if we see that risk appetite continue, then of course we're really looking for indices probably to continue to the upside, which most likely factors in S&Ps back to 4,200, potentially 4,225, 50s at a potential fib extension point up here. But also just being clarity as well within the price actions, those would be the most important thing. Similarly with the NASDAQ as well, NASDAQ has been very, very choppy. Now, of course, we did see decent volatility tail end of last week, very, very aggressive buying in the NASDAQ all the way up to the upper levels of this range. Now, you'll see marginally NASDAQ is still holding relatively stable above this 13,000 level, but I think today is going to tell a big picture, because of course, if risk orientation is to the upside, NASDAQ tends to outperform those other assets because it holds a higher risk rating. However, if there's negativity, you tend to see the NASDAQ sell off more. So that tends to be a clue that rather than trading Dow Jones, potentially NASDAQ may be a better option because of its risk annotations with these markets as well. All right. Finally, then, really looking at US 30, you will see that US 30 really has come back to where it started all the way through 2023, right? We had that massive sell-off through February into mid-March, into that Paddy's Day bottom around 31,500, 31,800. But then we saw that massive rally back up to really where we came from. That 34,200, 34,300 level has held very, very nicely over the last week or so, really into the end of April, into the early parts of May, as where we have the FOMC tonight as well. So, of course, watching that very, very closely. And again, structurally speaking, you'll see where we were last week. The Dow Jones, very, very strong reaction off of April session lows. You can see that very, very clearly. And of course, we rallied up to take new highs, mitigated this value area way over here at around 34,200 before moving lower again. So it just really depends on what way sentiment is at the minute. It's very, very choppy. Now, of course, we are still creating higher highs, higher lows. So if you are looking at selling, you're really looking for those month-end lows really to be taken out. So NASDAQ or S&P, month-end lows at 4070. Around this 4060 area. Dow Jones similarly down here around 33,200. So the break of structure, that break of trend where we've been very bullish in the US indices for the last, let's say, 8 weeks or so, 10 weeks, that's really your kind of catalyst for any sort of shift in sentiment. Those breaks of structures, those taking out of lows is really going to be kind of a catalyst for increased volatility. And that's probably what I would be focusing on as a new trader tomorrow or into tonight with the FOMC as well, more broadly. All right, so that's pretty much it for today. Everyone, we will be back tomorrow because, of course, tomorrow we do have ECB as well. We will be looking at ECB in a separate video because, of course, the volatility that we're seeing in these markets and how nimble and how shifty these markets can be over very, very short periods of time. We'll review the ECB separately tomorrow just to, again, look at that on its own merits as well. All right, trade safe this evening, everyone. Of course, factor in your risk management. Risk management is really the cornerstone of everything. Making sure you're following your trading plan, sticking to those risk tolerances. They're there for a reason within any organization, and just making sure there's clear structure in terms of what you're doing as well in terms of the execution of those positions. All right, trade safe, have a good day, and of course, everyone, best of luck tonight for the FOMC meeting.